Welcome to the Tax Compass podcast, navigating UK tax for expats with LSR partners. So welcome back to the Tax Compass podcast with us LSR partners and me, Simon Rouet, and my business partner, Laura Tan.
Hi.
This is a bit of a weird one. You can see that we're headphoned up. We're not in our usual studio. By studio, it's my dining room. I'm actually in France. So I'm about 35 miles south of Calais, staying in a rather nice chateau, actually. Why am I here? Well, because I was terrified that she was going to announce, and by she, I mean, of course, Rachel from accounts was going to announce an exit tax today, which could have been quite painful. So I was here so that if necessary, I could actually break UK tax residence. I've done my required amount of work today, so that today could have been my first day working full-time overseas. I could have applied split year treatment and she could have kept her grubby paws off my assets. But anyway, she didn't announce that. So it means that our booking on the Le Shuttle back to Blighty on Friday can still be used, and I can go home and cry into my cornflakes over the weekend about the budget. But we thought it would be helpful for our viewers to get a bit of a hot take on some of the things that were announced earlier today in the House of Commons. Well, in fact, of course, they were announced beforehand when the OBR managed to leak her report before she'd even stood up. I thought it was quite amusing that the first thing she did was completely turn on the OBR. First sign of a problem, it's all their fault, even though they bail her out with the way they do a lot of their budgeting. And I guess the starting point then is, what were the big headlines? So Laura, do you just want to run through the big change in terms of continuing with the stealth tax to income tax?
Yeah, no worries. So I think the big thing from an income tax perspective, that there were two things that would affect most UK tax residents. The first thing is that personal income tax threshold rates and national insurance rates as well have been held for longer than anticipated. So I think they were due to be held until 2028. They're now being held until 2031, which, as we've discussed a few times, is known as a sneak tax, because the idea is they hold the rates as they are. Doesn't sound awful. It sounds like they're not raising anything. But because of inflation and people having pay rises, etc., it's going to push more people into the higher rates and the additional rate of tax where they previously wouldn't have been.
And this is an interesting one, right? Because one of the things that is so absurd, frankly, around this entire process is they freeze them for an extra 3 years. They say that's going to raise £9 billion. In actual fact, it's not going to raise any money at all because it's in the future. But what it does do is it allows the OBR to change the forecast tax take over the forecast period, and therefore create fiscal headroom by literally doing nothing in terms of bringing in a single extra penny to the revenue. And it might all change, right? By the time we get there, things might be different. Pay rises may not have come through. So it just does go to show that the whole thing is a complete forecasting jamboree rather than it actually being a tax thing, just to that extent. But there have been changes to actual rates that will actually impact actual people.
Yeah, and I think it's actually quite interesting the way they've just made those adjustments, because one of the things they've always talked about is this, for working people. And in the run up to the budget, there was a lot of talk about adjustment to the income tax levels, which would have fundamentally gone against everything they said in their manifesto. And to that extent, they haven't, in terms of employment and self-employment income. But they have said that in terms of fairness, they disagreed with the fact that somebody who was receiving £21,000 worth of rental profits would pay substantially less tax. And when they say tax, they mean tax and national insurance, than somebody who is receiving £21,000 worth of salary. And as a result, what they've done is they are increasing income tax on rental profits, dividend income and savings income by 2%, as a reflection of the fact that there's no national insurance being incurred on those income. sources.
So we're effectively going to have income tax rates and rent rates or rental profit rates, and then dividend rates going up. But note, with the dividends, it's not the top additional rate; it's only the basic and the higher rate. And then for savings tax, i.e., interest tax, effectively, they're putting 2% on all three of the bands again. So effectively, interest and rental will be taxed at income tax rates of 22, 42, and 47, and dividends will be taxed at 10.75 and 35.75 in terms of the two first bands, right?
Yes. Which I suppose is likely to impact on quite a large number of our clients one way or another.
Yeah, absolutely. So now we talked about the sort of headline changes to actual rates, and it's probably just worth mentioning that the rental changes will come in 2027, and the savings income stuff will come in 2026. So they're not at the same time, but they are coming as actual rate changes. Another big announcement she made was all to do with voluntary national insurance contributions. Do you just want to talk a little bit about that? Because I think that's quite specific for non-residents.
Yeah. So at the moment, if you're a UK tax non-resident, you can, subject to meeting a few criteria, you can make voluntary contributions whilst you're a UK tax non-resident. And that is a way of you effectively topping up your state pension whilst you're outside of the UK. So in principle, you could be working outside of the UK for 10, 15 years and still come back to a full state pension. Under the current rules, you can, in principle, make either Class 2 contributions or Class 3 contributions. Class 2 contributions are £3.50 per week, whereas Class 3 contributions are £17.75, I believe, per week. And at the moment, I think usually if you've been working for about 3 years in the UK before you leave the UK and you're working full-time, or you're working whilst you're outside of the UK, you can elect to make Class 2 contributions instead of Class 3 contributions. What Rachel Reeves had said during the budget was that effectively it feels unfair that people who are outside of the UK are able to make cheap or buy cheap state pensions by making these Class 2 contributions. So as a result, they're going to abolish the availability of making Class 2 contributions whilst you're abroad. Can't remember if I've got a date for that. Do we have a date for when that would come into play?
I think it looked as if it was going to come in the next Finance Act, so I think it might be from April, but I couldn't find a specific date mentioned.
That's cool. So we don't know quite when that's going to come in, but it's going to be sooner rather than later. And the other thing that's going to come into play in terms of being able to be eligible to make these Class 3 contributions is going to be a lot more strict than it previously was. So you're going to have needed to have made 10 years worth of contributions or a UK tax resident for 10 years prior to departure from the UK in order to be eligible to make these Class 3 contributions. Again, I suppose what they're thinking is it's going to stop people from arriving in the UK, maybe doing 3 years worth of work, leaving the UK again, and being eligible to get a full state pension from the UK when they haven't really contributed that much directly to the UK. To the UK's pension pot. There's another couple of things that actually have kind of flagged up on the the tax documents, the budget itself. The actual tax documents for the budget are not yet, they haven't been released yet, because we are filming this quite shortly after the budget. So we haven't had time to digest significant amounts about it, but there are two things that have been flagged within the budget document itself in relation to non-residents. So the first thing is in relation to a basic rate tax credit that is available. So at the moment, if you're a UK tax non-resident and you receive dividend income, this is effectively, comes alongside a basic rate tax credit. So effectively, if you're a basic
UK dividend income, just to be specific.
Yes, for UK dividend income. So if you say, for example, you have a rental property, you're a British national or you're eligible for a personal allowance as a non-resident, the rental profits sit within your personal allowance. And then you receive, let's say, £10,000 worth of dividends. Now, these £10,000 worth of dividends would have a basic rate tax credit. So in principle, when you come to your tax calculation, you'd see, oh, there's tax due of those of 8.75%. So I guess on 10 grand, it's about £875.
175 quid.
So less than 500 quid taxed at 0%, but there or thereabouts. And then you'd see a tax credit of £875 for that's kind of this non-refundable tax credit on the dividend income itself. Moving forward, that's not going to be available. So I think that's from the 6th of April 2026. Is my current understanding of the situation. Yep. What that means, I suppose, for people with a slightly higher tax liability, than they would have if, like, under the old regime. For other people, you might find, say, for example, there's substantial amounts of dividend income. You might then find that they end up going down the disregarded income route, and they lose their personal allowance, their rental profits become taxable. So it's fundamentally, for a decent amount of people, certainly our client base, who when they're non-resident tend to have a bit of rental income and maybe a small amount of dividend income, they're likely to see their tax bills go up. So the other thing that we saw for non-residents is to do with anti-avoidance rules and temporary non-residents. Currently, if you own a close company and you take dividends whilst you're a UK tax non-resident in relation to profits that were built up within the company before your departure from the UK, and you are considered to be temporary non-resident in the UK, then when you repatriate back to the UK, all these dividends that you declared whilst non-resident would fall back within the scope of UK taxation. There was, however, a special rule in terms of if there was post-departure trade profits, which means that, say, for example, you left the business open, continue to trade from outside of the UK, the profits kind of within the UK business were created, and you kind of you extracted the profits, but it was in relation to those post-departure trade profits. Then under the current temporary non-residence rules, these would not fall back within the scope of UK taxation under these under temporary non-residents anti-avoidance rules. By the looks of things, they are going to be abolishing that from 6th of April 2026, so that effectively, if you're taking dividends from close companies, whether that's UK or non-UK companies, then, and you're temporary non-resident, those dividends are going to fall back within the scope of UK taxation upon your repatriation to the UK.
So it looks like, as often is the case, because non-residents, generally speaking, don't vote, they're always a good target for a good squeeze in these sorts of situations. So that's covered off on the non-residents thing. The one thing I'd add is that there was some noise around non-resident capital gains tax. In the notes, it seemed to refer to cell companies where they were going to look at anti-avoidance. But again, we'll have to wait for the publication of the documents to see whether there's anything else for non-residents in terms of capital gains tax. But it feels to me that if, for example, they were going to go, this is probably famous last words, but if they were going to go after, for example, the rebasing of properties to 2015, it feels like we'd have probably seen something a little bit more that way inclined in the documentation that's come out in so far. So let's hope on that one. Although to me, it's always seemed like an obvious thing to kill, given it's now 10 years old. But there we go. I think as well,
you might expect that if that had been the case, that would seem like a bit more of a headline news than
a bit more political of one that you can announce about, like, non-residents get some benefit and we're taking that away. That's the sort of thing Labour love, isn't it?
Yes.
All right. Shall I talk a little bit about pensions? Because I thought that was, of all the announcements, I thought that was the most sneaky. Because everyone really understands fiscal drag now, right? So everyone bangs on about it in the media about the fact that more and more people are going to get caught by in higher tax levels. That it's a stealth tax, but it's lost its stealth. But I thought the pensions one was really, really sneaky. So the announcement was, we're going to limit salary sacrifice to £2,000 a year for employees. But that's okay, because if you want to make contributions up to your full annual allowance, and we're not changing the annual allowance, you can just do that through your tax return. And so therefore, really, this is just a technical change. Of course, what she very much didn't say was what the NI impact was going to be. So the way it works currently is that if I earn, let's say, 150,000 quid base salary, and I put 20,000 quid into my pension via salary sacrifice, my employer only pays employer national insurance on the net amount, i.e., 130,000, because for tax purposes, they are treated as paying me 130 grand, not 150 grand. And so all of the difference, they get a saving of their employer national insurance. And what a lot of employers will do is they'll say, well, we've saved that money. We know your salary is really 150 grand. We'll put the 15% on that 20 grand into your pension scheme for you. It hasn't cost us any more as an employer, but you're now getting a benefit into your pension. With this change, the sneaky thing about it is that if I were to do that now, I'd be like, okay, I can do 2,000. So I'm now paid 148,000, not 130,000. And suddenly my employer really owes 15% on 18,000 quid, which they have to then pay to HMRC. So you would expect that what employers will naturally do is they'll say, well, we were hit with a 1.2% rise in employer national insurance this time last year. We're now being effectively hit again. Well, I'm just not going to give it to you as the employee. So I'm afraid we're going to cut your pension contributions by whatever the increase in our employer national insurance is, because you've now got a higher salary for NI purposes. And it's also worth noting that whilst in the example we're using, you're above the upper earnings limit, so national insurance for the employee is only 2%, it is still 2% on, in my example, 18,000 quid that will cost the employee in terms of what their actual take-home pay is versus having made the whole thing via salary sacrifice. And then the final thing, which people often forget when you're thinking about getting tax back for pension contributions, is that the great thing about salary sacrifice is that all the money goes into the pension and can therefore grow. If you stick in that additional 18,000 quid and you put it in your tax return, yes, you get a tax refund, but the tax refund comes into your bank account. It doesn't go into your pension scheme. And if you then want to put that money into your pension scheme, you have to make another contribution to your pension, which eats up your annual allowance in a way it wouldn't have done had you been able to put it in through salary sacrifice. So it's effectively bringing your annual allowance down. And if you're like a tapered person, so you've got only an annual allowance of 10,000, that can make, it is still marginal, but it still is an impact. So you lose even more of your annual allowance. You can't put the money into your pension because your employer is almost certainly going to say, well, sorry, I'm clawing that back. I'm not giving it to you. So I saw one estimate. They think it's going to cost 5 billion in terms of the value of pension contributions, or the value of pension pots is the impact. And I think that must be an annual number.
Yeah.
And I did some calculations, and I did it where someone was making a 5% contribution and the employer was making a 10% contribution on a pension on a salary basis of 150 grand. And over 20 years, that person's pension would probably lose about 50 to 70,000 quid's worth in value. If you look at it on a sort of compound annual growth rate model basis. And it's things like that when you're looking at all this stuff about savings, and it's what I can just never understand is, surely it's a good thing people are saving for their retirement. And eventually they're going to bring in they're going to have to bring in means testing for the state pension. So surely you want people to have bigger pensions.
Yeah.
But again, I guess it's they love this whole idea of nailing employers on their national insurance contributions, and it's just making hiring people more and more expensive. So I thought that was one which, so far, at least in the media, I haven't seen a lot of coverage of it. But I mean, when I looked at it, I was like, but they're saying you can still get the relief by doing it through your tax return. Oh, it's not that much of change. And then you think about the details and the interaction with national insurance, and it really does make a big difference.
I think the other thing as well, which is, I mean, it's a minor point, but like the additional relief that you're eligible for if you're a higher or additional rate taxpayer, you actually physically have to claim. And so there'll be people who maybe do tax returns, and their accountant will kind of say, well, let's find out what's going on with your pensions. a lot of people, and even though it's been announced, there'll probably still be a lot of people who will be quite clueless about how pensions are actually run.
Well,
And
how
some
many
people
how many people do we have come through to us who have all sorts of pension issues with annual allowance tax charges and all the
yeah,
rest of it? And it's a completely and it's an absurdly complicated way of doing it. And this has just complicated it further. And there must have been some modeling done on exactly that point. Like, okay, how many people are actually going to claim the relief?
yeah,
So it's the same thing all over again, isn't it? And we
yeah,
want to keep this snappy, so we'll move on to a few of the other quick things. I thought
yeah,
there was a lot of coverage, obviously, in the media. Again, the sort of running things up the flagpole thing about property taxes and mansion taxes
yeah,
and all the rest of it. So, as I understand it, the high value property surcharge, council tax surcharge, is a really snappy name, isn't it? Is going to be, I think, was it 2,500 for houses above 2 million and 7,500 for houses above 5 million.
yes.
But thankfully, if I mean, thankful for small mercies, I suppose that's not coming in until 2028.
2028.
Yeah. Um, there was some stuff on gambling. They're going after online gambling, but
Did,
excluding horse racing. Weirdly, can you bet on horses online? I assume you can, but I didn't really
did
seem to make much sense.
did they announce anything formally about the revaluing of the different bands F, G, and H?
No, no. They didn't do anything on council tax. So I think it's simply. I think what they were going to do was there was a lot of leaking about they were going to basically put 100% surcharge on bands G and H.
Yeah,
That's now gone, and there's this other surcharge which is expressly fixed at a value. Because I think the problem is that like that she made a comment about someone who had a house in Darlington was paying something and someone in Westminster was paying less.
yeah,
And I think part of the problem would be that like where we are in the Midlands, bands G and H still exist, but the houses in them are worth much less. So
yeah,
if they'd have just done it on a bands basis, you'd have been again penalising people who are living in lower property price areas, and they're obviously clearly after. Yeah, so there was an analysis done about 60% of these properties will be flats because if you've got a 3-bedroom flat in Mayfair, it will be worth 5 million quid or whatever the number is, right?
yeah.
Um, so yes, there's that. There was the change
No,
to they've changed some of the reliefs. Sorry, go on.
I was going to say, while we're talking about mansions and whatnot, one of the things that had been suggested was maybe a cap on principal private residence relief. If you're selling your main home, if you had expensive properties, that doesn't seem to have been introduced.
No, I mean I think a lot of it, right, is she got a lot of money out of the fiscal drag point. Um, And there's obviously been a lot of this, which is let's run the most absurd ideas we can think of up the flagpole,
Yeah.
get
And there were a
everyone
lot.
absolutely up in arms. And it's like, we were terrified about what they would do to partnerships in terms of national insurance.
Yeah.
And we sort of come away from it going, oh, thank goodness they didn't do that. And
Yeah.
I do think that, it was really interesting. The first time I've ever seen this at a budget where the deputy speaker spent the first 5 minutes basically berating the government for having leaked the entire thing in the media.
Yeah.
And that's obviously been a big part of their tactic is to sort of, as I say, you shove these absurd ideas out there, get everyone completely up in arms, and then we sit here. And I feel that way tonight. I mean, it's like I'm in France because I thought we could be heading towards an exit tax, and they were talking about 20% as an exit tax.
Yeah.
And you sort of come away from it thinking, oh, thank God I can go home and I don't have to worry about it. Because otherwise it would have been like, right, I've got to become a peripatetic tax consultant from goodness knows where for the next 5 years. I mean, it's just ridiculous, right?
Yeah.
So, I mean, I
Yeah.
suppose you'd say, well, politically, maybe that was the way to do it to sort of make people think, well, it's bad, but it's not that bad.
Yeah.
Yeah, no, it's ridiculous, isn't it? They've changed ISIS as well, I think, haven't they?
Yeah, so in terms of ISAs from the 6th of April 2027, they are reducing the so they're holding the threshold in terms of what you can put into your ISA, but from April 2027 onwards, only 12,000 per year can be put into a cash ISA. The rest would have to go into a stocks and shares ISA if you wanted to make the full 20,000. I believe there was almost a bit of an acknowledgement about the older generation in terms of over 65s. I believe will get away with, but they can have the full 20,000 for putting into cash ISAs. And then the other bit that was mentioned, but I haven't seen any details yet, was about, obviously they're on about being encouraging people to invest. So various reliefs available There was suggestion of upping some limits to EIS and VCT, like the amount of relief you'll be able to. I think it's not necessarily the increased rates of relief, but the amount that you can physically put in and invest is going to be increased. And I think I heard something right at the start, but I can't quite remember, which was about something about the first 3. If you're listed in the UK for the first 3 years, is going to be some sort of relief on stamp duty, I think. But don't quote me on that particular point. Just as a final note on my side anyway, there was a couple of things that I've seen in the budget document, very high level, that I thought was quite interesting. The first was that they'd mentioned that they were kind of looking at further developing the tax offer for high talent new arrivals. From our perspective, that tends to suggest that they're not necessarily quite happy with how the new FIG regime, foreign income gains regime, is looking, and they are potentially looking at ways to make it appeal to people to attract the best talent, which again sounds quite promising, albeit it was very much in the stages of we are looking at it rather than we know exactly what we're going to do. And the other one that they put was about offshore anti-avoidance, and that they are putting more into finding out about offshore anti-avoidance and flagging it down. I know that we're getting more and more queries through from people who are receiving nudge letters from HMRC. So I suppose to that extent, if you are in I suppose my guidance would be if you're in a situation where you know you haven't been reporting offshore income and gains, with the starting point being that if you're a UK tax resident, unless you're claiming any sort of relief or the double tax treaty permits it, if you've received income outside of the UK or gains outside of the UK, the starting point is that income and or gains is going to be taxable in the UK. And it is worth checking what is going on, because actually, if you know that you're in that position, it is far better to get ahead of the game and to notify HMRC yourself that you're going to do a disclosure, because your penalty rates are going to be lower, than waiting for them to come knocking on your door, because more and more people are being surprised by the fact that HMRC are kind of alerting them to income that
and there's just generally as there was in the last budget, there's more money going into HMRC for crackdowns on anti-avoidance. There's a thing where you can get more rewards if you sneak on other people. It's such a great thing to be encouraging people to do, isn't it? It's like the Gestapo and the curtain twitchers. But there we go. All right. Well, I think that's probably been a pretty good high-level summary. I think everyone knew tax raises were coming. They have arrived. It could have been Armageddon. It's probably just a bit of a tornado. But equally, when you think about what the money's being used for, it's benefit spending, basically. They're getting rid of the 2-child benefit cap. They're increasing the minimum wage for 18 to 20-year-olds well above inflation. So again, it makes it even more expensive to hire people. So it's sort of hard to see how this is going to help. She banged on about growth creation. I mean, I don't quite understand how that tallies with this, but there we go. We'll have to wait and see. Thanks for joining us, everyone. We're going to leave it there, but what we will be doing is doing a bit more of a deep dive on some of this stuff in a slightly less frenetic way when we're all back. Now there's no exit tax in my dining room. If people want us to talk about specific things, it'd be great if you can comment under the videos. We keep an eye on that stuff, ignoring the rude comments, obviously, and focusing on where people have suggestions for things that it would be useful for us to talk about. So I guess we can park budget hat until the same thing starts. It seems to now be like 3 months out that they start leaking ideas to raise even more tax. So I guess we'll be back talking about it sometime in the early autumn of 2026 if this government is still existing by then. But we'll have to wait and see. Please like and subscribe. You know where you can find us. We're on YouTube. We're on the I think what I'm supposed to say is wherever you get your podcasts. We'll see you next time. Thanks for joining. Thanks for listening to the Tax Compass podcast, brought to you by LSR Partners, where we help you pay the right tax in the right place at the right time. Book a call with us. Details are in the show notes.